Last 3 years before 2024 have been great years. Anything you picked made money.
Equities are never linear in terms of returns.
That's
There
right.
will always be volatility.
You're saying so that we need to be even more cautious. Is it just because the valuation gap is even higher?
If you are looking at mid and small caps, they're
Today, as we speak, US kind of sucking out all the liquidity from across markets, including India.
even today we have not seen a complete control on inflation.
How do you think RBI under the new governor would think about delivering rate cuts to the economy? Hi friends, this is our New Year's first podcast with you. Hopefully we are recording it on 18th of December, but we are going to take it live first thing in 2025. So let me start by wishing you in advance a very happy New Year, Harsha.
Thank you so much. I wish you and all the viewers a very, very happy and prosperous 2025.
So Harsha has been a dear friend and my senior colleague from Kotak AMC, now CIO Equity, and I've personally seen the growth of both Kotak AMC and Harsha over the years. And I must also congratulate you. Recently, you've crossed 5 lakh crore in AUM. So,
Thank you so much. Thank you for your support and all the trust that has been placed by all our investors.
Yeah. So, Harsha, broadly we'll want to cover two main tracks today. One is how do you think about the current state of markets, and what are your expectations or how you are looking at 2025? As we mentioned, this is the first podcast we'll make live in 2025. But other than that, before we go there, you've been with the group now for how long, or in Kotak AMC?
It's
how
been
long?
more than 12 years now.
12
I joined
years.
in August 2012.
So this is something which I keep on reading, and there's a lot of literature outside India around this. Not so much in India because India still is somewhat of a young market as compared to global standards. So they place a lot of premium on longevity of the fund manager, or the fund manager staying with a particular investment company and investment manager, or managing the same fund for a very, very long period of time. So in your opinion, is it necessarily true that the more time a fund manager or a CIO has spent with a particular AMC or with a particular fund actually over a period delivers better returns, or it does not matter?
See, it all depends on the institutional framework that each investment house will bring. For example, if it's an institutional process, what it means is even if there is a change in fund management team, the processes are so clearly defined and the boundaries are very well drawn so that nobody can deviate from those boundaries, and hence the investment process at least follows a particular path, right? Now, the question of the longevity of a fund manager, every individual has a different style. However, there is an institutional framework to monitor the overall boundaries. So, to an extent, that same fund manager continues with the same fund or the same strategy. Obviously, there is that continuation in terms of the portfolio construction, because none of us are going to build a portfolio for the next 1 week, next 10 days. Right?
Correct.
So, we are all building it for the medium to long term.
Yeah.
So, to that extent, that continuation definitely helps.
Okay.
But more than that, I would say the institutional framework is very important.
So you're saying institution is more important than the individual?
That's true.
Okay, great, good to hear. Okay, so let me get back to how you're looking at markets currently. So I'll just share what I'm thinking, and then obviously you are the expert. Uh, Last 3 years before 2024 have been great years, right? Anything you picked made money. 2024 also, maybe till couple of months back, it was looking very rosy. It almost felt it will be a deja vu, same story will get repeated, and then off late last 2.5 months, it has been somewhat of a bumpy ride. Okay, it was slightly more felt in small and mid caps, but frontline indices also haven't done that well. So overall, we are looking at for the year maybe 12-13% return on Nifty, maybe slightly more on mid cap, small cap, but they had gone up much more. They have come down actually recently, right? Uh, uh, so the way at least I was trying to get my arms around this question about the current state of markets is, markets had run up. Somehow earnings have not caught pace. In fact, I'm sure a lot of our viewers would have read also last quarter was quite bad in terms of aggregate earnings growth. Obviously, there will be differences between sectors and companies. Given this framework, in general, what is your thoughts about the current state of markets, and maybe if you can share something how you felt 2024 overall went by, or overall it has behaved while you were going through 2024?
See, as far as 2024 is concerned, I think from the time that we started the year until now, there have been several events that have happened, both
That's
at
right.
the economic front as well as at the corporate level. And also, there have been
Political
several
also.
global events, including political events.
Yeah.
Right. Despite all of this, equities have given very, very strong returns, not just in India, but across the globe, one can
Yes.
say. However, what has changed towards the second half of 2024 has been how our economy has been doing and how our corporate landscape has changed, right? So clearly, there has been a deceleration in terms of economic growth in the last 2 quarters, which all of us have seen. We have also seen corporate earnings not matching the same pace as what it used to be in the previous couple of years. It has been growing at a very muted rate of about 3.5 to 4% year on year for Nifty basket, for example. And also in the second quarter of this financial year, we have seen mid caps and small caps actually degrowing by about 15 to 20% in terms of earnings. So
Whereas the stock prices have actually gone
that's
up.
right. So this is probably the first time after COVID disruption that we have seen this kind of a deceleration in terms of earnings.
Okay.
And at the same time, the market has continued to ignore the slowdown in earnings and has continued to move up. So in effect, what has happened, the valuations have expanded in the recent times. So when we start going into 2025, we need to remember that we are entering 2025 at much higher valuations than what we entered 2024 at. And also the earnings scenario is not as bright as what it was supposed to be in 2024.
So I have one question here. While you're right that maybe the valuation or valuation comfort is much lesser as of now, but let's say last year also when I was chatting to many of your friends in the MF industry, then also no one said that small and mid caps especially are cheap, right? There was somewhat of a view that large caps are looking better versus mid and small cap, because again if you go back 2 years from last year, small and mid caps have done significantly well, significantly outperformed large caps, right? So 2024 के beginning में भी ये story तो था कि small and mid caps में valuation comfort कम है थोड़ा. Still on a relative basis they have done better versus large caps in this year also. Even after the whatever downfall in the indices, at least we have seen over the last 2-3 months. Why do you say that we need to be, or if you're saying so, that we need to be even more cautious on small and mid caps? Is it just because the valuation gap is even higher, or do you feel that earnings might not be able to kind of maintain the momentum that they had?
So, before answering that point, I would like to take a step back and tell you that equities are never linear in terms of returns.
That's
There will
right.
always be volatility.
Correct.
What has happened post COVID has been very, very different in terms of the investor experience, because at whichever point one has invested, one has probably made money and very strong returns, to say the least. So, to that extent, people seem to have forgotten the valuations and they have been only looking at past experience and expecting that past experience to continue, which is not the right way to look about. Okay. If you look at current state of earnings, current state of valuations, clearly there are two things that we need to remember. One, the valuations are higher than average valuations that we have seen in the long term for equities in India. Especially if you are looking at mid and small caps, they're at a very, very high premium compared to historical averages as well as to the large cap segment. So, on a relative basis, clearly the mid and small caps are at a significant higher valuation as compared to large caps. That's point number one.
Okay.
Second, between 2020 and 2024, we have seen earnings of large caps growing at about roughly 17-18% CAGR, whereas the mid and small caps earnings grew by about 30 to 35% CAGR. Okay. So to that extent, a part of the big move that we have seen was also driven by the earnings differential where mid and small caps had superior earnings as compared to large caps. Now, let's look at what's happening now. In the last 2 quarters of this financial year, we have seen earnings of large caps growing at only at about 3.5 to 4% year-on-year basis. This is one of the lowest earnings that we have seen in a half year as compared to what we have seen. So, and when you look at mid and small caps, they have actually degrown by 15 to 20% during the second quarter of financial year.
Okay.
So now the question is, can we forget the earnings slowdown and the expanded valuations, and can we still expect the kind of returns that we have made in the past? So in our opinion, I don't think that is going to pan out. Equities will still deliver decent returns. They will still remain one of the better asset classes for investors to own from a long-term perspective. However, the situation will be not similar to probably 2020 to 24.
Okay.
So the expectations need to be moderated, and also one should be okay with some volatility that will come every year now and then.
Okay, so I will come to what we are thinking about 2020 or what you are thinking about 2025 in a bit. But you mentioned earnings slowdown. But why do you think it has happened? What's the reason?
See, the reasons for economic slowdown could be multiple reasons. One definitely seems to be the slow spend that has happened from the government.
Okay.
Although the budgeted numbers were expected to grow at low double digits, what we have seen for the first half of this financial year has not been as good as what the budgeted numbers were.
Okay.
Now, usually in an election year, you would have seen a slight miss in the initial part, and then the capital expenditure picking up for the government. However, this time that slowdown has continued into the next few months as well. So that's where that slow economic pace would be coming from. That's one. Second, on the rural side, we are still not seeing a complete normalization post-COVID. Probably this is the segment which got impacted more than the urban consumers during COVID. And also last few years, the weather patterns have not been so great. And probably they used up all their savings during COVID because many of them had to migrate from cities to rural areas, and the jobs in the rural areas were very, very minimal, etc. So because of all this, the rural economy was kind of under some sort of a stress. Maybe that is also leading to a slowdown in the overall
Demand
economic
slowdown.
growth. So there are and as it is, the global growth has not been very strong. So to that extent, the exports have also not been as expected. So multiple reasons, but definitely I think the higher base of previous year, as well as what has happened during this financial year in terms of the capital spend, etc., would have led to a slowdown in economy.
Okay. So, okay, then let me lead the same point into 2025, and maybe we'll talk about what you are thinking about the markets or asset classes slightly later. But if I lead this conversation, the same point that the two big demand drivers, which is government spends and let's say consumption overall, which will be a mix of urban and rural. You spoke about rural, but let's talk about urban as well. As we move into 2025, do you think that these two big drivers, there is something which will change the needle or move the needle, or they are expected to remain sluggish going into 2025 calendar year as well?
On both these fronts, we expect a gradual recovery. Incrementally from this quarter onwards, we should see a better capital expenditure numbers from the government, as well as the consumption trends also should start to see a little bit of improvement. However, the big improvement is unlikely in the very short term. So to that extent, it's going to be more of a gradual recovery. But I don't think one should be too worried about that part, because our economy is still expected to grow at around 6% or so for the next year. So I think the economic growth is still very, very strong compared to the global backdrop that we have. It's just that the earnings have not been growing at the same pace as 2020 to 24 CAGR numbers. Because if you look at the very long-term earnings growth of India, it has been hovering somewhere around 13.5%. And we had a situation for 4 years when it grew much higher than that run rate.
Yeah.
Now, because of that high base, as well as some slowdown that we are seeing in the economy, there has been some deceleration in that number.
Okay. So it's more cyclical in nature, you're at
That's
least
right.
thinking about. Okay, so let me now delve into the second track which we wanted to discuss, which is when you are now doing a crystal ball gazing for 2025, what are you thinking? So two parts to this question, Harsha. The first part where I'd like to get your views is among asset classes, and then second specifically within equities, right? Within equities, then sectors, etc. We can chat about. So this year has been 2024. I'm talking about was great for gold, for international investing, specifically US. And again, if you look at comparison, gold itself has given maybe 25 to 30% return point to point, whereas equities have not, right? Now, since you are in your capacity as a CIO, you have view on all asset classes, and Kotak has multi-asset allocation funds and balance advantage funds where uh, the fund manager is trying to kind of allocate money among asset classes also, right? If I go into 2025, would you want to kind of hazard a guess, or what is your view in terms of among asset classes? Today, as we speak, US suddenly has become the market of choice, and which is kind of sucking out all the liquidity from across markets, including India. It has sucked out a lot of money. Going into 2025, and there's this big event of Mr. Trump actually taking office, and how geopolitics will shape up, etc. How are you looking at among asset classes view? Which asset class do you think will do better versus the other?
That's the reason why we need to keep valuations in mind whenever we make investments, right? One of the reasons for banking stocks not to deliver the kind of returns that the market has delivered in the last 4 years or 3 years is the fact that the entry valuations then were not so cheap,
Okay.
right? And the other thing that was very different was before COVID, for example, for almost 4 or 5 years, private banks especially were the pool of companies which actually delivered much higher earnings growth as compared to the rest of the market and rest of the sectors, right? Now that situation changed post COVID, where there were many segments of the market or the economy which started delivering better earnings growth and significantly better earnings growth than banking stocks. And that coincided with high level of valuations for banking as well. So that's where the returns have not been so great for banking. Now what we believe is the valuations have become quite attractive in comparison to market as well as in comparison to their history. That's point number one. Second, most of the challenges that the banks have been facing are well known and well discussed in the market. So to that extent, we believe the problems that are there in terms of the deposit mobilization or in terms of what's happening in specific pockets of lending,
Like
where there has
microfinance, etc.
microfinance or unsecured lending, where there have been a little bit of asset quality issues, etc. Most of these are well known and well discussed in the market. We believe that those are already discounted. That's point number one. Second, as we spoke about how earnings are looking for next couple of quarters, we don't see markets significantly delivering very high earnings growth. And banking, for example, will should remain more or less steady in terms of earnings delivery. So to that extent, the choice that one can make would be to continue to bet on pockets where there is no earnings delivery at very high valuations, or another pocket where there is valuation comfort and a reasonable delivery of earnings. That's where we believe that probably the situation will change. However, even now, I would say that one should not invest for only 2025 or next few quarters. It should be more of a long term approach. But at these valuations and at these situations that we are seeing in terms of the asset quality issues or the growth issues in the bank, and the overall context of the bank, I think we should be able to make decent returns from here on for a long-term investor.
So I think this is a very nice and valid point you made, and which is a live example. We are seeing that why entry valuations matter so much. That although banks have also done really well over the last 2, 3, 4 years, but because when
Correct.
if you had invested in 2019 at the valuations which were prevailing then, although your underlying company has done phenomenally
Correct.
well, but the stock has not done well.
That's right.
And that is what possibly can happen to many of these other sectors where in fact there is a possibility that the earnings may also disappoint.
Correct.
And valuation comfort to hai hi nahi.
Yes.
Okay, I think this is very nice. Second sector, Harsha, which I wanted to want your view was on, you mentioned IT services also might do well. Uh, but there's this entire big hangover of especially in US and maybe other countries also, of trying to insource stuff, right? Try to do stuff in your homeland, make in America, and some of those stories which are going around. In such a setup, do you still think that the kind of demand, because now the Indian IT services industry is very large, so at that base, to grow the kind of orders or the kind of demand which is required to propel the earnings is of a very, very high magnitude. Do you think in such a setup it is reasonable to expect that they will get the kind of orders that they require?
Uh, if you look at post-COVID situation, there was a frenzy in terms of the IT spend that happened across the globe, and there was a huge business momentum for IT services companies from India, and that kind of decelerated in the past few years. Now we are seeing a cyclical uptick in terms of that discretionary spend coming back. So that's point number one. The second is world over, people are betting on AI. And if you have to adapt to AI, you have to migrate your databases on the cloud before that. So for the cloud migration, I think there are a lot of Indian IT services companies which will really cater to that kind of a demand. So that's a medium to long term demand that one can expect. And thirdly, in the U.S. economy, the President-elect Trump has made a statement that during the manifesto that they would be looking at cutting corporate taxes.
Okay.
So if that materializes, that means that the American corporations will have more spending power. And generally, whenever you have higher profitability, you will try to increase the efficiency of the business. So IT spend should continue at a larger clip. So given all of this, we believe that not only there is a cyclical improvement that is likely to come in the existing businesses, but there are also a couple of other large opportunities in front of us as we look ahead.
Okay, great. So I think the last sector which I will want to talk about, which you mentioned as a dark horse, personally, you know, in my personal portfolio, whatever little bit I can manage, I am very skeptical about consumption, and I'll tell you my reasons also. Right? Uh, Obviously, consumption has never been cheap in India, and today also it is not cheap. But I am not seeing those uh, green shoots, which possibly you can see from where you are sitting at, which will lead to those demand recovery, which can give me returns from this already very, very high valuation level. So yes, you mentioned it's a dark horse, which means the probability of it happening is lesser than some of the
Correct.
other sectors, but my confidence level is really, really low in consumption. So is there something that you're kind of sensing which can kind of give me a little bit of more confidence in consumption? Or
Yeah. First of all, I think when you look at valuations, not only we need to look at absolute valuations, but also we need to look at historical valuations as well as relative to the market kind of valuations. So if you look at average valuation of a pure consumption stock, I'm not talking about consumer durables, I'm talking about consumer staples.
yeah,
Those valuations are at an average valuation of last 5 years.
okay,
But they have always been higher than market.
always,
They have always been higher than many other sectors. So to that extent, we always feel that they are expensive.
yeah,
But compared to their own history, they are at the average level. So that's point number one. The second, where do we see green shoots coming from? Our thesis is right now, for the last few years, the food inflation has been running quite high. And also, if you look at the pricing of most of the FMCG products, which are used for mass consumption, for example, bread, biscuits, soaps, detergents, all of this, the CAGR growth in some of these categories is anywhere upwards of 6%. Right.
okay,
So when you look at rural segment, which has already seen its probably some of the savings going away because of the COVID disruption, not getting back into the same shape as they were earlier, etc. In that context, if you are seeing the consumption basket having a price increase of about 6% plus CAGR, and also food inflation running very high, that means that uh, if you have an income of 100, the rural population spends most of that 100 on food, for example, whereas in the urban consumption basket, the food will not be as big a percentage.
yeah,
So since food inflation has been running so high, we have seen most of their consumption going into only food requirement, but not into some of the other consumption segments. As we expect food inflation to moderate, because this year the monsoon was really strong, we have had a very strong agricultural season. The next season is also likely to be very strong, and hopefully next year monsoon should also be a decent one. So if this prognosis comes through, then that means that the confidence of those rural population would be much higher than what it was in 2024.
So they can
And
spend more.
that's the thesis that we are working with.
Okay.
Obviously, right now there are no strong tailwinds for that. It's more of an expectation at this point of time. That's why I said it's a dog horse. You have to wait and watch. You have to keep monitoring that segment. And if some of these theses comes through, then I think there is money to be made.
Okay, fine. My final question to you. We just got a new governor at RBI, and Mr. Das, great innings, and how kind of he managed the entire monetary policy through very, very challenging times. Hats off to him. But now we have a new man at the job. Do you think we are looking at quick rate cuts, because economy definitely is asking for it? There is slowdown, but then there is inflation also, which maybe it's not that slowed down. It has come down a little bit. It has not come down as much as a rate cut would have become a sure shot certainty. How do you think the RBI under the new governor would think about delivering rate cuts to the economy?
See, I think clearly their decisions will be dependent on the data points that they would be seeing over the next few weeks and quarters, right? While, as you rightly mentioned, there has been a slowdown in growth, it's not so severe that you need to have a cut right now. That's point number one. And also in the context of how the globe is growing, 5.5 or a 6% economic growth rate is not very bad. The second point is, even today we have not seen a complete control on inflation. Inflation is still running above the RBI intended rate. So to that extent, we think that yes, there is a scope for a couple of rate cuts, very shallow interest rate cycle this time. But even those interest rate cuts would be in 2025, and it will be more dependent on the data points that RBI would get at that point of time.
Okay.
But I don't think it will be a very, very significant interest rate cycle this time around. It will be a shallow one.
So neither it will be a very deep rate cut cycle, and also it's not a certainty कि अभी बस आ ही गया January में.
That's right.
That's right. Okay. Because that influences a lot of other, let's say, heavy industries, infra, etc. If that happens suddenly, you can see some kind of a valuation bump up again. Our EMIs will go down. We can spend a bit more. That will kind of help the economy. But yeah, so that also possibly is a dark horse, isn't it?
But I think next 12 months we should see some interest rate cuts, maybe a couple of interest rate cuts of 25 basis points or so. But other than that, to pencil in a very, very strong rate cut cycle in the given circumstances, I don't think that should be the base.
Great. So I think very nice chatting with you. Wish you the best and wish all our investors the best and very, very good 2025.
Thank you so much.
Thank you so much.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.